Hey everyone, welcome back to the Deep Dive. Today we're going to dig into a company that's been making waves in the beauty world, ELF Beauty. Now their stock's been on a bit of a roller coaster ride lately, down about 45% from its peak. But here's the thing, over the past 5 years it's still up nearly 680%. So is this a dip worth buying? Or a sign that the party's over? We're going to take a close look at a recent analysis from the Motley Fool to see if we can figure that out.
Yeah, ELF is a really interesting case study. One of the things that's made them so successful is they've really tapped into this sweet spot in the market, offering quality makeup and skincare, but at prices that don't break the bank. And that's been a huge draw, particularly for younger consumers.
Makes sense, right? I mean, who doesn't love a good deal, especially when it comes to looking good? But it's not just about the price point, it's also about results. ELF has racked up an impressive 23 consecutive quarters of market share gains. That kind of consistent growth is definitely something to pay attention to.
Absolutely, and they're not just a domestic player anymore. One thing that's really caught my eye is their aggressive expansion into East Asia. We're talking about a 91% jump in sales outside the U.S. just last year.
Well, 91%, that's massive. But why East Asia specifically? Is it just that the market there is beaming? Or is there something more strategic going on?
Well, it's a combination of factors. You've got this rising middle class in East Asia, especially among younger generations with more disposable income. And these consumers are very much aligned with ELF's target demographic, digitally savvy, trend conscious, and looking for value. On top of that, there's a growing preference in the region for cruelty-free and vegan beauty products, which fits perfectly with ELF's brand ethos. So you've got this perfect storm brewing for ELF to potentially dominate that market.
Sounds like they're in a prime position to capitalize on that growth. Let's face it, breaking into a new market, especially one as competitive as East Asia, is never a walk in the park. Are there any red flags investors should be aware of?
Well, one thing that stands out is their increasing marketing spend. Now, while it's clearly been effective in driving growth, it's also putting a bit of a squeeze on their profit margins. Their operating margin, which basically tells us how much profit they're making for every dollar of sales, peaked above 15% last year. But recently, it's dipped down to 10%. And that suggests that their marketing efforts might be becoming less efficient.
Okay, so is this a sign of trouble ahead? Or is it just the necessary cost of doing business in such a fiercely competitive market? What are your thoughts on that?
Yeah, that's the million-dollar question, and it's something the Motley Fool's analysis tries to address. They're projecting a 29% jump in revenue in fiscal 2025. And after that, they're predicting a still healthy but more conservative 20% growth over the following 3 years. They're also banking on ELF getting back to that 15% operating margin.
Okay, so those are some pretty optimistic assumptions. But are they realistic?
Well, it's hard to say for sure. A lot hinges on how effectively ELF can navigate that East Asian market. Can they really carve out a significant chunk of market share while maintaining profitability? That's a key question investors need to grapple with.
And that's not the only thing to consider. Let's unpack some other crucial aspects of their business model right after this quick break. We were just talking about those pretty ambitious growth projections from the Motley Fool and whether they're actually achievable. It's easy to get caught up in the hype, especially with a company like ELF that's had such a remarkable run. But I think it's crucial to zoom out and look at the bigger picture here.
Yeah, I totally agree. One thing that often gets overlooked is the competitive landscape. I mean, the beauty market is incredibly crowded. How are ELF's competitors responding to their success? Are they cutting prices? Are they ramping up their own marketing efforts? These are dynamics that you absolutely have to factor in.
That's a really good point. ELF can't just assume they'll maintain their momentum without a fight.
Yeah.
And speaking of competition, what about consumer trends? I mean, tastes change, new products emerge. What's hot today might be old news tomorrow. How confident are we that younger shoppers will stick with ELF over the long haul?
Yeah, brand loyalty is a fickle thing, especially among Gen Z and millennials. They're constantly bombarded with choices and influenced by social media trends. ELF has done a phenomenal job of capturing their attention so far, but they can't rest on their laurels.
So how can they stay ahead of the curve? Are they investing in innovation? Are they experimenting with new products, new marketing strategies? These are the kinds of questions I'd be asking myself if I were considering investing in ELF.
For sure. And let's not forget about the elephant in the room, the overall economic climate. A recession could really throw a wrench into even the best laid plans. Consumers might start tightening their belts. Discretionary spending on things like cosmetics could take a hit.
Right. And then there's the whole issue of ELF's supply chain. They're sourcing ingredients and manufacturing products globally. How vulnerable are they to disruptions? Think about things like geopolitical instability, natural disasters, or even just a sudden spike in shipping costs. These factors could have a significant impact on their bottom line.
Yeah, absolutely. And speaking of factors that could impact their bottom line,
Hmm?
what about the management team? Do they have the experience and the vision to navigate these potential challenges? Have they demonstrated an ability to adapt and innovate? These are crucial things that often get overlooked in these kinds of financial analyses.
I'm so glad you brought that up. It's so easy to get fixated on the numbers. But ultimately, investing is about betting on people. The success of any company, ELF included, hinges on the leadership's ability to execute and deliver.
Right. And let's not forget that the Motley Fool's analysis, while insightful, is just one perspective. They've made certain assumptions about ELF's future. But those assumptions may or may not pan out. It's so important to consider different viewpoints, weigh the risks and opportunities, and ultimately form your own conclusions.
Okay, so with all that in mind, how does the Motley Fool ultimately assess ELF's stock? Do they think it's a buy, a sell, or a hold? Let's dig into their final verdict.
So after all that analysis, where do they land on ELF's stock? It's interesting because despite being pretty bullish on the company's growth potential, they're not totally convinced about the current valuation. They actually think the stock might be a little overpriced right now.
Oh, really? That's kind of surprising given everything we've talked about, their track record, their marketing savvy, that massive potential in East Asia. What's making them hesitate?
Well, their main concern is that a lot of that future growth is already baked into the current stock price. Remember those optimistic projections we discussed? 29% revenue growth in 2025, a return to that 15% operating margin. The Motley Fool's thinking is that even if all of that comes to fruition, the stock's current price might not leave a whole lot of room for further upside.
So they're basically saying that, yeah, ELF is a great company, but the stock itself might not be the screaming buy it seems like at first glance.
Exactly. It's a classic case of a company's fundamentals being really solid, but the valuation maybe getting a little ahead of itself. And it really comes down to risk versus reward. If you buy in at today's price, you're already paying a premium for that expected growth. And if those growth targets aren't met, or if any of those risks we talked about start to materialize, the stock could take a hit.
Makes sense. So where does that leave our listeners? What are the key takeaways they should be walking away with from this deep dive?
I think the biggest takeaway is that investing isn't just about identifying great companies. It's also about understanding the relationship between a company's performance and its valuation. ELF might very well hit all those ambitious goals, but the question is, are you comfortable paying a premium for that potential?
It's also a good reminder that no single analysis, even from a reputable source like the Motley Fool, should be the be-all and end-all of your investment decisions. We've highlighted some really important questions to consider: the competitive landscape, consumer trends, the broader economy, their supply chain, the strength of their management team. These are all things you need to dig into a bit deeper before making a decision.
Absolutely. Think of this deep dive as a starting point, not the finish line. Do your own research, read different perspectives, and ultimately decide if ELF Beauty aligns with your own investment goals and your risk tolerance.
Well, that wraps up our deep dive into ELF Beauty. We hope you found this exploration informative and maybe even got you thinking a little bit differently about the company and the beauty industry as a whole. As always, keep exploring, keep learning, and keep diving deep.